This is the Borderless Crypto Podcast. Hello everyone, I'm your host, George Manilov, and in this series I bring you exceptional entrepreneurs, investors, hustlers, and thought leaders from the cryptocurrency and fintech space. Hello dear listeners. It's been some time since I published an episode, but now I'm back. And I'm sharing an insightful conversation with Matt Houghan, the head of research at Bitwise Asset Management. You might have heard of Bitwise in the beginning of this year when they published a report that exposed that most exchanges out there are having fake volumes and that there are only 10 cryptocurrency exchanges which are actually reporting real trading data. Now, apart from doing research, Bitwise is actually the first provider of crypto asset index funds. And in my view, these are important tools for the growth of crypto's market cap as they allow accredited and institutional investors to easily enter the crypto asset investment class. Now, before entering crypto, Matt was the CEO of ETF.com, where he created the first ever ETF data analytics system. He's also the person behind the biggest ETF conference and the biggest ETF website. Now, if you're wondering, hey George, what the hell is an ETF? Don't panic. In just a couple of minutes, Matt will explain it to you in detail. Matt and I also discuss in depth the history of gold, along with the recent introduction of tokenized gold coins. Matt goes on to explain why he doesn't hold gold in his personal portfolio, and instead why he does hold Bitcoin and other crypto assets. He further outlines the characteristics which make Bitcoin an emerging store of value, and he draws some absolutely fascinating similarities between the history of gold and the history of Bitcoin. Please note that anything that I or my guests say in these talks is for informational purposes only and should not be treated as investment advice. And although during daylight I'm part of the team behind the crypto lending platform Nexo, at night, when I do these talks, I share only my personal thoughts, which in no way represent Nexo's opinions. Now it's time to get the podcast started in 3, 2, 1. Matt, as a start for this conversation, could you please share a little about your background?
I was involved in the ETF industry. I was the CEO of ETF.com. Created the first ETF analytics system, the first ETF data system, which now powers all of FactSet's ETF data, as well as the largest media site, the largest conference in the ETF space. And I bring that up because obviously one of the biggest ETF stories over the last 15 years was the introduction of GLD and other gold ETFs in the middle of the first decade of the 2000s. GLD was the fastest growing gold ETF ever to launch, hit over $1 billion in 3 days, was briefly the largest ETF in the world, and remains a significant way that investors gain exposure to gold. One more thought there, and I'll pivot to tokenized gold. GLD, I think, was a game changer in terms of allowing people to easily access gold. It allowed people to buy and sell gold in a truly liquid format at spreads that they had never had before, and to use it as a portfolio asset in a way that simply hadn't existed before. Prior to that, some central banks had gold holdings, but retail investors mostly accessed gold by buying gold miners and not by having direct gold exposure. And so the launch of that made it easier for people to get access to the returns of gold and made the discussion of gold's place in a portfolio sort of come to the forefront and be at the front of people's minds. And I think that attributed significantly to the uptick in gold prices that we saw in the first decade of the 2000s.
But for those listeners who don't really know in depth what an ETF is, how it works, because a lot of people in the crypto space have just been owning crypto assets. So what is an ETF and how can one get into an ETF?
Sure, that's a great question. An ETF is just a mutual fund that trades like a stock on an exchange. So in the same way you might open a Coinbase account and be able to acquire digital assets like Bitcoin and Ethereum and other crypto assets. You could open an account with a traditional broker like Charles Schwab or TD Ameritrade or E-Trade or some of the newer generation brokers like Robinhood. And you can buy exposure to ETFs that represent a variety of assets, whether that's US stocks or international stocks, or indeed things like gold, oil, and a handful of other commodities. So they're sort of the modern version of traditional mutual funds. And GLD was the first gold ETF and was really the first time that you could buy gold by clicking a button. Before that, you had to go to a jeweler or gold trader or buy it through a futures account. It was complex and the costs were high. And GLD made it as easy to buy gold as it was to buy a share of Apple. That's the role that it played.
Okay, having said that, gold ETFs do not have the backing of physical gold itself, right? Like you cannot exchange your investment in a gold ETF for physical gold.
It's nuanced to that. So it's backed by physical gold in that the fund, which is an independent entity, owns gold in HSBC's warehouse in London, and you get a pro rata right to that. But you as an individual can't redeem. You can't like trade in your ETF and get actual gold. As an individual, you can only trade in your ETF and get paid cash. So one of the things about tokenizing gold, I mean, there are two reasons that tokenized gold, I think, is interesting, maybe even three reasons. One is that a number of the tokenized gold projects that are out there allow this sort of redemption for physical and allow you as an individual to have sort of direct, verified, one-on-one, sort of peer-to-peer ownership of gold, which is interesting. And two, just a lot of trading is moving into tokenized assets. Settlement is easier. You get a global network. And so it just represents a new way to invest in gold.
Now, there's probably a third thing which I've been considering. So, for example, who can access GLD or other gold ETFs? Like, is it available for people of any nationality and any location, or is that harder? Because I have the feeling that it's not really accessible for anyone anywhere.
I think that's fair. I mean, there are gold ETFs that exist in other countries, and in many major developed economies, I think it would be relatively easy to gain exposure. But when you get into places, into certain emerging market economies, and notably India, I know that it's not easy for the average person to access these sort of mainstream financial products. So I think, a lot of the interest in tokenized gold comes from finding a pathway to allow people in emerging market economies the same kind of access to gold as we have at our fingertips here in the US.
You mentioned earlier on that the gold ETFs for the first time in the gold market history made the bid-ask spreads between buy and sell very tight. Why was that, and how big are the spreads today?
That's a great question. So before the Bitcoin ETF launched, really the only way to buy and sell gold was on the over-the-counter market. Realistically, that meant for most investors going down to like the gold shop and buying gold coins from your local retailer. And there wasn't a national or international market for most investors to access. There's obviously a significant market in London for gold, the LBMA dealers. If you're in London in a major institution, you can get relatively good pricing. But for most retail investors, their best choice was to go buy coins or bars from their local dealer. And like any local retail merchant, the spreads that you pay there are significantly higher. So you're talking about spreads of 1, 2, 3, 4, 5, 10%. And what GLD did was it brought that onto a national, high-speed, arbitraged, regulated exchange market. And the spreads are 1 penny. So if gold is trading at $1,300 an ounce, you can trade it with a spread of a penny, which is pretty phenomenal. So it just made it significantly easier to access, but also brought in the cost of trading dramatically by bringing it from an OTC sort of isolated market into a centralized exchange traded technology driven market. And as a result, the prices came in.
You've mentioned the GLD ETF, but at the same time, there are a bunch of other gold ETFs, not just in the US, but I believe all over the world. So how would one and how should one go about selecting where to invest if one wants an ETF, a gold ETF exposure? What's your view on that as probably one of the most experienced persons in the ETF space?
My view is that most investors in the US who are retail investors are probably best served by just buying the cheapest gold ETF, which I think the ticker on that is BAR, BAR from Granite Shares. It provides the exact same exposure as GLD, but costs a little under half as much. If you're an institutional trader, there are reasons to buy GLD because it has greater liquidity. But for most retail investors, a fund like BAR works very well. As you said, there are a large number of these ETFs. They all have unique wrinkles. Some store their gold in Switzerland, some store it in London, some distributed in multiple locations. It depends on how much that matters to you. None of that would matter to me. I think these ETFs are safe and secure, and therefore I'd buy the cheapest one, which is BAR. But all that said, the two big ones, GLD and IAU, also give you good exposure and are also relatively low cost. So you can't go wrong. You can find out about them, honestly, for free on the website I used to run, which is ETF.com. So if you just go there and type one of those tickers in, you can learn more about them.
Beautiful. Definitely put the links down below this recording. Before we continue this discussion, just curious yourself, do you hold gold as an asset in your portfolio, or like physical gold or gold representation in the form of an ETF?
It's a great question. No, I don't. I'm a fan of gold and I understand the role that it plays in certain people's portfolio. I don't hold it in my portfolio. I don't feel like I need that role. My alternatives allocation and my non-correlated asset allocation is held in crypto. But I respect people who have gold in their portfolio and I understand the place that it can play.
Why do you choose to hold Bitcoin over gold?
That's a great question. I think when you think about gold, you have to think about capital preservation, right? So there's an old saying about gold that an ounce of gold will buy a good man's suit, and it has for hundreds of years. In other words, 200 years ago, you could walk into a tailor with an ounce of gold and get a good suit. And today you could do the same thing. But it's not the case that you can now buy 2 or 3 or 4 or 10 suits. So it's good at preserving your wealth and insulating you from sort of the ravages of currency inflation, but it's not good at wealth creation. So what the place Bitcoin sits is it's an emerging store of value. So I think eventually, if we fast forwarded 20 or 30 years, I think Bitcoin will occupy a very similar place in the world to gold in that it's a non-sovereign scarce asset that you can hold and protect yourself from inflation in fiat currencies. But right now, not everyone believes that Bitcoin will play that role. And as more people come to believe that Bitcoin will play that role, its price is going up. I think that explains a lot of why the price has gone up so much over the last 10 years. And I think we're still early in that process. So I hold Bitcoin in my portfolio because like gold, it has low or zero correlations to stocks and bonds. In other words, it doesn't move like stocks and bonds. But unlike gold, it's in a period of capital appreciation as opposed to just capital preservation.
Now, you have a very interesting comparison between gold and Bitcoin in terms of historical comparison. So you essentially said that gold is a store of value and Bitcoin is an emerging store of value. Could you please elaborate on the comparison between those?
That's absolutely great. So the thing that people today amazingly don't get about gold is that for hundreds of years, gold was just tied directly to currency and held at a fixed currency rate. So the US was on the gold standard. Other currencies were linked into the US, and the price of gold didn't move until the 1970s. And between 1971 and 1973, the US broke off of the gold standard, and we entered this new era of fiat money. As we entered this new era of true fiat money, gold also entered a new era, which was it became this non-sovereign store of value. There was no government backing. It had no tie to traditional fiat currency. And what happened in gold during that period was fascinating. So from 1973 to 1980, gold went through this amazing period of appreciation. The price of gold went up 1,300%. It was hugely volatile. Some years the price went up 120, 130%. Other years the price fell 20 or 30%. It regularly had large moves, I think 1 out of every 10 days or so, it had a 3% move. So gold was in an emerging store of value space. So there were people who believed it would be a non-sovereign store of value, and there were people who thought it would be cast in the dustbin of history as a barbarous relic, as Keynes would call it. After sort of 1970, it entered a mature phase where most people accept it as a non-sovereign store of value, a place to park wealth. And since 1980, its compound annual return is 1.9%. But during this sort of chaotic 70s period, when it was emerging as a store of value, its price appreciated tremendously. Bitcoin is in that equivalent to gold in the 1970s. That's the period that it's in. There are some people like me who believe in the future that there will be a digital non-sovereign store of value and that Bitcoin will own that space. And that space could be as big as gold. And if you believe that, you think the price of Bitcoin should be substantially higher than it is today, right? If much value is stored in Bitcoin as in stored in gold, Bitcoin's price would be about $500,000 per Bitcoin. So there's some people like me who believe we're on that journey. And then there are a bunch of people who don't, who think Bitcoin will never amount to much, who think it's worse than tulip bulbs, to use a common saying, and that its value will go to zero. So that difference in opinion is what creates the volatility that you see. But as more people shift into believing that Bitcoin has a role to play in the world, that volatility declines and the prices go up. And that's what we've seen. Bitcoin volatility, as volatile as it is today, is significantly lower than it was 5 years ago. 5 years ago, the daily volatility was about 10%. Now it's down to 3%. I think we're in this period where Bitcoin is going through what gold went through in the 1970s. As a result, you're seeing the same thing you saw in gold, which is massive price appreciation and a falling of volatility. And I think eventually we'll get to the point where Bitcoin is relatively boring, where its volatility comes down and it's a good store of value. But until we get there, we're in this period of massive capital appreciation, and it's a very interesting time.
Okay, couple of questions. First of all, one simple yet important question for part of our audience would be, what are the features that you find in Bitcoin which make it an emerging store of value aside from, just price movements? Why do you think it could become a substitute or a complement to gold? Why would people choose Bitcoin as opposed to gold?
That's a great question. I'll answer it two different ways because I think it's really important. So for one, Bitcoin shares a lot of the core values that gold has. It's scarce. It doesn't decay. It can be divided. It can be exchanged for fiat money in 200 countries around the world. It's a solid asset that doesn't go away. So it's very much like gold in its characteristics. It's just a digital version. In fact, and this was the other point I was going to make, one way to think about Bitcoin is it is the world's first scarce digital asset. In the past, any digital asset could be essentially copied by copying the code. Bitcoin is the first thing that we can say is truly scarce. There's a limited quantity of it. That quantity will never increase, and you can't simply copy and paste and create more. So I think as the first scarce digital asset, it is naturally filled into a role similar to gold, which is a place to park money. My general philosophy on these things is I think the internet was a fundamental disruption in society. And I think we've seen a huge number of things move from the physical world into the digital world. A huge number of things that people were skeptical about for many years. So people were skeptical about media like newspapers moving into the digital world. People were skeptical about commerce moving into the digital world. People were very skeptical about advertising moving into the digital world. But in each case, today, the digital version of retail, of media, of books, of advertising are all as big or bigger than their physical component. So I think it stands to reason that now that we have a scarce digital asset, there will be a digital version, if you will, of gold, a scarce asset where people want to store money online. I think, why do people want Bitcoin instead of gold? Well, as I said earlier, it's in a different place. So gold is about capital preservation. Bitcoin is right now about capital appreciation. And a lot of people are looking for capital appreciation. Long term, I could argue Bitcoin may become bigger and more important than gold because while it shares all the core characteristics of gold in terms of being, divisible and stable, fungible, exchangeable for fiat currencies, it's also transportable instantly anywhere around the world. And it's a lot easier to store it. It's not bulky and you can move it across borders with a password in your mind. So it sort of does the same thing as gold, plus it does a bunch of other things. I think over time, it may actually become the most important non-sovereign store of value. So I definitely think there's still a role for gold in portfolios. It's been around for thousands of years. It's much more stable. It's unlikely that it's going anywhere. But I think Bitcoin is sort of disrupting that space in the same way we've seen other digital versions of traditional physical things disrupt retail and commerce and advertising and telephones and many other things.
That's totally fair. But at the same time, you were saying that a digital version of gold makes a lot of sense because a lot of other things have become digital. And Bitcoin is one version of a digital gold, but then tokenized versions of actual physical gold itself are now becoming a reality, right? So wouldn't it make sense that these new versions of an asset, which is already proven throughout history, it's something that people understand, people know. There was this one person I was watching and he said, everybody in the world knows what's gold and very few people know what is Bitcoin. And it's very hard to explain what is Bitcoin, whereas everybody understands gold. And the moment it becomes super cheap, easy, accessible, understandable to access gold, even if it's not its physical, but it's digital, tokenized representation, it has the potential to grow as much as Bitcoin has, but it still delivers a lot of potential. One thing that also comes to mind is that, as you said, gold has been used as a store of value, but people don't usually walk around with gold in their pockets. They don't exchange gold. They don't buy stuff with gold. But once you have these tokenized versions, which is easy to accessible, then gold could once again have its use as a medium of exchange, as a unit of account, as it used to be in the past.
All of that is a very real possibility. I wouldn't circumscribe the possible implications of a digital version of gold. I think to the extent that it makes it easier for people to acquire it, that will be positive for the price of gold. Again, hearkening back to the ETF, the fact that the ETF made it easier for investors in developed markets to acquire gold, I think contributed significantly to the strong returns it had in the first decade of the 21st century. I think unlocking that ease of access for people in emerging market economies through a tokenized version of gold could have the same sort of positive tailwind impact on gold prices. I think it's definitely possible. I think you could imagine a world where it became used as a medium of exchange. I'm a little bit less bullish on crypto's application as a medium of exchange outside of this sort of stablecoin world, because I think even though fiat currencies have their issues, people are paid in fiat currencies and there's basis risk in using a different currency. But I can imagine a world where that is true as well. So regardless, every time you open up the possibility of acquiring an asset like gold to a new group of investors, that's a tailwind for prices. And so to me, the bull case for tokenized gold is making it an easier for people, particularly in emerging market economies, to gain exposure and to buy and sell the asset. So that's the primary use case. And I agree there's a possible world where it returns to its role as a medium of exchange.
Hey, my friends, I want to take a minute off here to honor Nexo, the company which is funding this podcast. Nexo has built two fascinating products, which I'm sure will be useful to you at some point in your crypto journey. Nexo's first product are its instant crypto credit lines, which let you use digital assets as collateral to get cash in 45 fiat currencies and stablecoins. You can borrow anytime. You can use a variety of crypto assets as collateral: Bitcoin, Ether, Litecoin, XRP, BNB, Bitcoin Cash, Stellar, and Nexo keeps adding more assets on a regular basis. You can pay off your credit line anytime with fiat, stablecoins, or crypto, whatever works best for you. And the best part is, all of this comes with zero fees. Forget origination fees, transaction fees, or penalty fees. The only thing you will ever pay on the Nexo platform is the interest rate on the credit lines that you borrow. And these start from just 5.9% per year. That's it. Now, if you are not looking for loans, you will love Nexo's interest earning accounts, which will generate you an annual interest of 8%. And again, this product comes with absolute flexibility for you. You will earn interest on a daily basis with the ability to add or withdraw funds to your account at any time, without losing any of the interest you have already earned. You can explore more at nexo.io. That's NEXO.io. Now back to our conversation.
Here comes the question of what's your view on fiat gold and Bitcoin long term? Because you say that Bitcoin is an emerging store of value. Now, do you believe that it can grow into a real store of value over time? Or do you think it could also substitute the role of fiat money? So, a lot of people, especially the Bitcoin Cash holders and the Bitcoin Cash community, believe Bitcoin should be used as a medium of exchange, as a peer-to-peer cash system. And not just them, but a lot of crypto holders, also Bitcoin holders, believe that once Bitcoin becomes a store of value, once it becomes less volatile, it could substitute largely, if not completely, fiat currencies overall. What's your stance on that?
For the most part, I'm skeptical of that in developed market economies because no matter how stable it is, you'll be taking on significant basis risk versus the prices you see in everyday use. So if your mortgage is denominated in dollars, but you're transacting, or if your salary is in dollars, but your mortgage is denominated in Bitcoin, you're taking on significant risk of price movement. And most people don't want that risk. I think the place where it could fill that role, and I wouldn't be shocked to see it fill that role, is in economies that have significant challenges in maintaining their currencies. And you see that all the way around the world. In fact, the majority of countries have inflation rates that are significant and have real issues with their domestic fiat currencies. So in the US, where I live, I find it unlikely that I will be using Bitcoin as a significant medium of exchange anytime in the near future. But could you see countries in emerging markets Bitcoinize in the way that they currently, some of them have chosen to dollarize? I think you could see that. And I think you see significant penetration over there. And there's already sort of established examples where digital versions of transferring value have become the dominant means of exchange in emerging market economies like Kenya. So I do think there's a possible application there. It's not the primary use case that I'm personally most excited for in crypto assets. I'm really excited about the store of value use case. I'm really excited about sort of disrupting traditional financial services. And the third piece of a medium of exchange, even though it was in the founding title of the Bitcoin white paper, I think is a hard nut to crack long term. But I think you could see it in certain places in the world.
Another question which came to mind as I was listening to you and as you compared gold to Bitcoin was that with Bitcoin, there's a very significant amount of Bitcoin that is concentrated in rather small size of the population, let's say. I cannot cite numbers right now, but there's these price predictions, for example, that if Bitcoin truly becomes worth, one Bitcoin becomes worth $500,000, then we would see world's richest people who could be worth trillions of dollars each. So the early adopters of cryptocurrency. Now, don't you think that this distribution of Bitcoin essentially creates a huge vulnerability and a potential flaw in the system in the sense that these people, some of which are unknown, could have a huge impact and influence on the value of Bitcoin? So it can be a store of value at some point, and then one of them decides that for whatever reason, because when there's a person takes a decision to, for example, place a huge order out there, he could totally manipulate the price and he could totally play with the store of value thesis.
I don't worry about that, although it's a smart thing to raise. And I don't worry about it for two reasons. One, Bitcoin ownership has gone through sort of a period of exponential decentralization since its founding, right? Originally, one person owned 100% of all Bitcoin. And today, that's no longer the case. Even the largest single wallets are relatively small in the scale of Bitcoin's overall market capitalization. I think that radical decentralization will continue. And therefore, the concern that you raise right now, I don't think will be as big a concern in the future as extremely wealthy people choose to diversify their assets as any reasonable person would do. And the other reason is game theoretic. The people with the largest positions in Bitcoin actually are incentivized to have that asset be as valuable as possible. To suggest that they would sort of act against their own rational economic interest seems unlikely to me. It also runs counter to the data, which suggests that these large whales are actually the longest term holders of Bitcoin. So I understand the concern. Centralization of wealth is a concern in many areas. Centralization of shareholder ownership is a concern in corporate America. But I think if you look at the data, They tend to be the longest holders. There is this decentralization of ownership going on, and there is this game theoretic reason why they wouldn't act in their against their own self-interest. But it's something that's worth thinking about. I do think it's worth pointing out the Bitcoin market and the liquidity in that market has radically changed in the past 2 or 3 years. You now have some of the largest institutional, algorithmic, traditional Wall Street financial firms making markets in the Bitcoin market. And it's become just exceptionally more efficient. It's also become exceptionally easier to hedge your positions through the growth of futures market and institutional Bitcoin short lending markets. So the market that was so relatively easily moved maybe 4 or 5 years ago is not the market we have today. It's much more akin to a well-developed, a well-oiled two-sided market with lots of risk hedging tools in the options, futures, and other spaces. So it's a great thing to think about, but it doesn't actually concern me.
Another question which I had was, in your latest investor newsletter that you send out to Bitwise investors and subscribers, you had this reference to an article which essentially points out that the US dollar has lost 93% of its value over the past 100 years. And this trend is continuing. So with the recent actions that we are seeing from the president and the Fed, this looks like it will be continuing. And essentially, this is the nature of fiat money, right?
Yes. It's an explicit target of the Federal Reserve to have inflation rates above 2% a year. And if you compound something even at as low a rate as 2% over hundreds of years, you see the kind of dilution that you're talking about there. So yeah, I think it's a fundamental feature, even if we're not entering a massive inflationary future, which there are definitely two debates on whether the next 10 or 20 years is going to see significant inflation and debt monetization, as Ray Dalio has said, or if it's going to be more subdued because of technological advances, which some other people espouse. But when the Fed is targeting explicitly a couple percent of inflation a year with the potential to miss on the upside, yeah, you have to assume this is the nature of fiat money.
Do you think that there is a possible scenario where we could reverse back to a dollar or to fiat currencies which are backed by gold or by Bitcoin, essentially by hard money as it used to be before 72?
That's an interesting question. I think you'd have to see cataclysmic results for the governments to move to put the genie back in the box. And we go through a period of severe economic hardship before we got there. I don't think it's a zero chance. It's something that you hear more seriously discussed now than you did at the past. But I think it's unlikely, and the pathway to that would be very painful economically. So I'm hopeful that it doesn't happen, actually. But I don't think you can say it's a zero chance.
So I wanted to now get a little more into your work at Bitwise. If you could share a little bit about what you do at Bitwise and what is your place in the cryptocurrency space.
So Bitwise was created. It's a specialist crypto asset manager. We create simple crypto funds, mostly for professional investors. So we created the world's first index fund, which holds the top 10 crypto assets. And we have standalone funds that track Bitcoin and Ethereum. What we're trying to do is make it safe, simple, and easy for US investors to access crypto markets. Right now, particularly for professional investors like financial advisors and family offices and institutions, the means of accessing the crypto markets are not as easy as they should be. And so we've developed these funds that help make it easy. Our general position is that crypto assets have a role to play in many investors' portfolios, that they can help provide diversification and increase returns. And so we're trying to make it easy for people to do that. Practically what I do during most days, I spend a lot of time researching the crypto markets and then a lot of time talking mostly to financial advisors and to family offices about the role crypto can play in their portfolio. Those of us in the crypto world often are out of touch with how far away mainstream America is from understanding crypto. So we spend a lot of time trying to educate broad groups of people on what crypto is, why it matters, and how an allocation to crypto can fit in people's portfolios.
How do you do that in practice? Do you persuade people one-on-one?
Yeah, a lot of it's one-on-one. So we have a sales and distribution team who reaches out to financial advisors. There are 300,000 financial advisors in America. Collectively, they control about half of all the wealth in America. And we reach out to them on the phone. We go to cities around America and host lunches for 10, 15 people at a time. We speak at conferences and we try to write articles and pieces in the media that help people get their head around it. It's not true that it's easy for someone who doesn't spend their time digging into crypto to understand what it really is and where it fits. There's a lot of bad media reporting around crypto. There's a lot of misconceptions you have to break down. So we think it's a multi-year, multi-touch process. But practically the way we do it is by calling financial advisors, hosting webinars, hosting lunches in cities around America, going into offices and meeting them one-on-one. It's a lot of hand-to-hand combat.
So these are financial advisors of high net worth individuals, or at least accredited investors, I imagine.
That's correct. Yeah. All of our funds that exist today are available only to accredited investors. So that's what we're working on. We have also filed for a Bitcoin ETF, which is with the SEC right now, and they're reviewing it. But right now, all our funds are for accredited investors only.
And the ETF will allow basically anyone to...
Yeah. If the SEC approves our ETF and we're able to launch it, it will allow anyone to buy it in the same way that they currently buy Apple stock and through the same user interface and systems that they buy, Apple or Microsoft or Tesla or what have you. So that's the other piece that we're trying to achieve. Until we achieve that, we're doing what we can, which is offering funds for accredited investors only.
What are the biggest complaints that financial advisors or family offices or directly accredited investors that you talk to, what are their biggest objections or doubts or the reasons why they don't get in?
I think that's a great question. There are really three. So the first one is they just have a misconception about what crypto is. They figure they're not spending Bitcoin to buy their coffee at Starbucks, and therefore it's not a real thing. And so you just have to break down to them sort of the core understanding that what crypto does is it moves money onto the internet for the first time ever. That's a major financial disruption. And so some of it's just core education. From a portfolio perspective, Bitcoin is extremely volatile. We saw in 2018, it fell nearly 80%. It's gone through, I think, 70% pullbacks in the history of its life. And most financial advisors aren't used to assets that are that volatile. So getting them to understand that despite the fact that it's volatile, it can still have a place in a portfolio is a significant issue. And then the third one's a technical issue, which is that financial advisors typically buy funds through advisory platforms and custodians. So even though ours is a private fund, most of advisors go through a custodian like Schwab or Fidelity. We have to work with those custodians to make it easy for advisors to access our funds. So again, these folks are busy folks. We spend 24/7 thinking about crypto. These folks might spend 7 minutes a week thinking about crypto. And so bringing them up to speed with how the market has evolved and where the market is and where it's going just takes some time. So yeah, those are their concerns.
So essentially, very simply put, you allow at this point accredited investors they give you fiat, and with this fiat, you buy crypto assets and you custody them.
We work with a third-party custodian, yeah, but we let them invest in crypto funds that hold assets in an institutional custodian. And they would have difficulty creating that relationship or accessing and trading those assets themselves.
Do you do something with those assets?
Yeah, held in 100% cold storage. What our customers want is to know that their assets are safe, secure, and not going anywhere. So we don't lend them out. We don't stake them. They just sit there in cold storage as safe as they can be. And the advisors are able to participate in the upside in prices that we've seen since the creation of crypto.
What's the business model behind it? Is it just a retainer or a commission based on the amount of assets that your clients hold with you? Or is it some sort of performance-based?
No performance-based fee. It's just a straight annual fee, 2% for the institutional share class of our index fund and 1% for the institutional share class of our Bitcoin and Ethereum funds, and then slightly higher fees for the retail versions of those share classes, which is just a smaller investment level, but there's no performance fee at all.
Do you work exclusively with US citizens, or can people from other jurisdictions, I imagine if they are accredited, also join your funds?
We have an offshore fund that's available to all institutional investors for our index fund. So that fund has a $100,000 minimum. So that's the hurdle. But we have a significant number of international clients that access us through that offshore funds.
but it's focused on institutionals.
Actually, I believe it's the case that it's open to everyone as long as they meet the $100,000 minimum investment.
And if there's people listening to this, how can they go about and invest in your fund?
I would just go to bitwiseinvestments.com. That's our website. And you can find out about our offshore fund in the funds file, and you can reach out to us and we'll help you out. There's a click invest now button that will get you linked up with our investor relations team, and they can help sort out the paperwork and get you into the product.
Beautiful. One other question, which I wanted to ask in the beginning, but I still believe it's important, would be just curious, how did you yourself enter the crypto space? Did you read something? Was there some particular person who got you in the space?
Yeah, my first real interaction with crypto came in 2013 when I was running an ETF conference. And we had Tyler and Cameron Winklevoss come down and speak to our conference about Bitcoin. I'm good friends with the lawyer they were using at that time on their ETF filing, Kathleen Moriarty. And the fact that she took crypto seriously enough to work hard on that project made me take it seriously as well. So I followed it since then with different interest. And then after we sold my ETF business, I was looking around for the next major disruptive financial technology where I think I could have an impact. And crypto was it. I was fortunate to find Bitwise, which had a remarkable team and I think the best designed product for professional investors. And I've been happily involved 24/7 in the crypto industry ever since then.
How did Bitwise convince you, or why did you think Bitwise were better than Winklevoss Capital? As they're also working on an ETF, right?
They were working on an ETF. I don't know where they are with it. I was introduced to Bitwise through my good friend Spencer Bogart. Spencer's a partner at Blockchain Capital. Spencer used to work for me at ETF.com. The thing about Bitwise that I love, I'm an index investor at heart. I have a high degree of confidence that crypto will be more important in 10 years than it is today. But I have a relatively low degree of confidence in terms of which specific asset will be the most important. I could paint you a world where Bitcoin remains in its dominant position and indeed becomes more dominant, crowding out other assets and accrues most of the value. I could paint you a world where Ethereum fundamentally disrupts big chunks of the financial industry, becomes really significant. I could paint you a world where privacy coins fundamentally disrupt sort of the offshore wealth market, which is a $30 trillion market and have massive price appreciation. Or I could paint you a world where some new asset emerges with a extremely slick, scalable blockchain and disrupts these other established coins. And the truth is, I honestly don't know which of those worlds is going to occur. But what I do know is that the future of finance is going to run through crypto assets and blockchain. I feel very confident about that. And if that's what you know, what you want in the best of all worlds is a well-designed index fund that gives you exposure to all of those assets. So you can just park money in there with your one core thesis that crypto is going to be important and be guaranteed that you'll participate in the upside. And that was Bitwise's flagship product. They were the first company to offer an index fund in the crypto space. I was also very impressed by the founders of the firm and by their venture capital backers. And I just thought, I think this is going to be a really significant financial company in the future. I loved its culture. I loved its product. I loved what it was doing. And they were happy. And I was happy they invited me to join the firm.
As you said that you don't know which exactly asset it's going to be the biggest thing, how do you go about inside the fund allocating capital? Now, I know that at this point you have about 70% or more dedicated to Bitcoin. There's less to Ether, Bitcoin Cash, Litecoin, etc. I assume you have some sort of rules and mechanics in which you change that allocation over time. How does that work?
We let the market decide. So first, what we do is we look through the list of all existing crypto assets and we figure out which ones can be safely held and which ones are liquid. There's certain assets that don't meet our standards for custody. There's certain assets that don't meet our standards for liquidity, and we exclude those. And then what you're left with is a set of assets that can be safely held and easily traded. And then we take the market cap weight. In other words, the total value of Bitcoin versus the total value of Ethereum versus the total value of Bitcoin Cash is what determines the percentages. The beauty of this approach is that those percentages shift over time as the market decides which is the most valuable. Now, every month, we look at the market again and take the top 10 assets again, and maybe we add an asset that's emerging and drop an asset that's declining. But this index-based approach, it's now the dominant way people gain exposure to the equity market. And I think it's actually the most rational way to gain exposure to the crypto market. So the short answer is, after we make sure it's safe and secure and liquid, we let the market decide.
Talking about this, you're working on a Bitcoin ETF, but based on what you're saying, I assume you would also be working on an ETF that is based on the Bitwise 10 or some other sort of basket.
Yeah.
How is that going?
Yeah. The answer is baby steps. So right now, the SEC hasn't allowed any crypto ETFs to come to market. The first asset that they're likely to allow is a Bitcoin product, because the Bitcoin market is more well established than any other asset. It's the only market where there's a regulated futures contract. It has the most custodial options. It's the most efficient traded market. It's the oldest market. It has the most market makers. So the first door that the SEC is going to open, if they open a door at all, is going to be for Bitcoin. Over time, it's my hope that the space matures and we're able to bring a diversified index approach to investors in the US through an ETF. But we're right now a long ways from that. And it's not a criticism of the SEC. The SEC is there to protect retail investors from risks. And the truth is, there are significant risks as you move down the capitalization spectrum in the crypto market that, at least in the SEC's mind, I don't think they're close to being comfortable with. But over time, I expect there to be more ETFs and more diversified ETFs, and hopefully we'll be a leader in that space.
What is stopping the SEC yet from approving the Bitcoin ETF? And are they vocal about it? Are they clear about it?
They've done a great job, I will say. So they rejected the Winklevoss ETF in 2018, and they published a 92-page paper detailing the reasons that they rejected it. And they have concerns about a number of things, from custody to audit. But their real concern is that the underlying markets where Bitcoin trades, in other words, Coinbase and Kraken and Binance and all the others, are not regulated in the same way that stock markets are regulated, and in some cases aren't regulated at all. And so they worry that there is the potential for market manipulation on those exchanges. We've been working to try to use research and data to assuage their concerns, but that's their primary concern, that look, Bitcoin trades mostly on unregulated exchanges, and they want to make sure that the markets are functioning clearly, safely, and appropriately before they approve an ETF. So that's their blocking point at this point.
Shortly after I recorded this interview, the SEC actually rejected Bitwise's application for establishing a Bitcoin ETF. So we would have to wait for some more time before we see an ETF which would allow for traditional investors to get exposure to the Bitcoin asset class. But the good news is that, once again, the SEC gave a very detailed explanation, 115 pages explanation as to why they rejected the ETF. And so Bitwise have some good ideas to what they have to do differently when they file their next application, and they have already announced they will do it. So I wish the best of luck to Matt, and I'm sure that earlier or later, Bitwise will bring the ETF to reality and will let way more people to get access to the Bitcoin as an investment asset. A couple of things before you take off. First, if you enjoyed this episode, be generous and share it with your best friends. They deserve it, they will appreciate it, and they will be grateful to you. Second, I want to draw your attention to Nexo, without which this episode wouldn't be possible. If you're like me and you believe the long-term value of crypto will grow, then Nexo might be a useful tool for you. The company allows you to get instant access to cash in 45 fiat currencies without selling your Bitcoin, Ether, or other crypto assets. Now, in case you don't need a cash loan, Nexo can also guarantee you a passive income of 8% per year on your stablecoins, Euro, US dollars, and British pound. What's more, interest is paid on a daily basis, meaning you can add or withdraw funds to your interest earning account at any time. You should know that the level of automation, convenience, and flexibility that Nexo provides are vastly superior to what any other similar services offer. This is the reason why I myself joined the Nexo team. Having said that, none of this is investment advice. I just genuinely believe these services might be useful for you.
you can explore more at nexo.io. Finally, if you have any suggestions, feedback, or anything you want to tell me, you can find me on Twitter at borderlessbtc or on my website, borderlesscrypto.com. Thanks for tuning in, and I'll see you soon again.